Stocks for beginners. Phil Muscatello and Finpods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation.
Going onto shares isn't buying shares just because everyone else is doing it. Well, that's not me. If anything, I'll look at that and say that's interesting, and then I'll look for, is there a contrarian position around that? So I don't tend to follow the herd in that respect. It's looking at objective data, independent analysis, and actually trying to work out, okay, what's appropriate here.
Hi, and welcome back to Stocks for Beginners. I'm Phil Muscatello. What do Kiwis do when they want to invest? Do companies that list on the NZX ring a bell or do a haka the morning of their listing? Joining me today to discuss investing in the land of the long white cloud is Oliver Mander. G'day, Oliver.
G'day, Phil. How you doing?
Very good, thank you. Oliver Mander is the Chief Executive Officer of the New Zealand Shareholders Association, NZSA, a position he's held since October 2020. He previously worked for 19 years at BP Group as well as Chorus, Z Energy and Wellington Water. And we met at the annual conference at the ASA this year in Sydney. How was that and what were your main takeaways?
Oh, look, I really enjoyed that conference. It's something that I try to go to every couple of years or so, and we do have a really good working relationship with the Australian Shareholders Association. They take a lot from us, and obviously we would like to take more from them and the skills and capabilities that they have. So, and look, watch this space. There's some things that we will do jointly as an Australasian set of organisations very soon, so we're really looking forward to deepening that relationship further.
Do you do any company monitoring like the ASA does?
We do it slightly differently to the ASA, but we've got full coverage of the New Zealand Stock Exchange. So we cover the 125 companies that are on the exchange. It's a much smaller exchange than the ASX, of course. But we do that in quite an engaging way. So we have what we would term a relatively strong relationship with every board, every chair, every CEO of those companies. To have a more centralised process than the ASA, and that simply reflects the scale of our operation. But look, we have a set of policy principles. We assess against those principles. We have a conversation with the companies with that, because it really is about ensuring that we understand their context as well. And that leads us to a form of constructive activism that is really quite unique in New Zealand. And we're able to put out improvements and work with companies to actually improve their governance long term as well.
So you've said the number of companies, which is 125. What's the kind of market capitalisation and the size and the shape, and what sort of companies are listed on the NZX?
Yeah, there are some very significant organisations there. So if the largest listed company as a New Zealand company in New Zealand is Fisher & Paykel Healthcare. Now that, of course, is listed on the ASX as well. It's a real feature of our market that many companies do dual list on the ASX, because really that's about broadening their investor base as well and ensuring they can attract a diversity of investors, both institutional and retail. So yes, Fisher & Paykel is our largest listed company. That's a market capitalisation of between 20 and 22 billion New Zealand dollars. So it's about 20 odd billion Australian. The NZ50 drops down to about, I think that the bottom component of the NZ50 is about 250 million as a market cap. So really quite a lot smaller than what you're seeing in Australia. The NZ20, if you're investing in that index, it's around $500 million, maybe a bit more.
Do you find New Zealand investors have a bias towards their own market like Australians do here? I mean, these days we can invest anywhere in the world, but do locals invest locally as well there in Kiwi land?
Oh, look, they do, and it's actually a problem for any market in the world. There is this thing called home country bias, and individual investors they can be subjected to that wherever in the world that you are. But I think what is really, most New Zealanders would invest outside of New Zealand as a matter of course, simply because that's just recognising that we're a tiny, tiny part of the global economy, and actually we want to make sure, most investors want to make sure that they diversify their investments in a way that makes sense for them. So, there's 125 odd listed companies. There's a range of ETFs on our market as well. There's probably another 50 or 60 of those. And that gives people an easy way to invest locally but still diversify their investments. But some will choose to invest directly in companies in the US or the UK or Australia. And that prevalence is probably slightly higher than what it might be compared to a larger market like Australia, simply because that most New Zealanders would recognise that we're a very small part of the world economy.
So ETF providers there, are they like the big ones? They've got set up local offices like Vanguard and VanEck and Global X and all of those? Is that the case?
So they haven't actually, no. So the largest ETF
okay.
provider is actually, the largest ETF provider is called Smart, and that's actually owned by the NZX itself. So they're operating as a passive fund manager at that point as well. And then there's a couple of other listed investment companies as well that are run by local funds. So for example, Fisher Funds Management, they're the manager for 3 or 4 listed funds that operate a global sector, an Australian investment sector, and a New Zealand sector as well. So, and those they can be actively or passively managed. And for your listeners, active is when the fund manager is actually doing work to try to beat the market, and passive is where it's just tracking an index. In this case, the NZ50 or the ASX 200 or whatever that index might actually be. So there are those range of options for investors on the NZX as well. But a lot of people would invest directly in those companies also, because it's a market you can get your head around as an investor. There's still choice there, and there's still some really good quality organisations to invest in. And if you spend time on that, it's actually something that you can get your head around in terms of understanding their fundamental value and understanding why they're attractive as part of a bigger portfolio.
Yeah, it really doesn't matter about the size of the market, though, does it? Because it's all about whether it's a good investment at the end of the day, isn't it? And it's interesting that you say that. You can, like having 2,000 stocks on the ASX, it's hard to track all of them, but 125 is almost a manageable figure.
Which it is. And look, a lot of active investors in New Zealand, there is, and that has been researched out, they will tend to beat the market. That's probably one of the few places in the world where that happens in the long term. And that's because it is a small market. You can have conversations with chairs and CEOs, boards, they're very accessible. And you can make your choices as an investor around that. So yeah, that there probably is a higher incidence of active investors actually beating the long-term market index return, which is quite unusual for a Western developed economy.
And what is the long-term market return?
In New Zealand, it's probably the last time we looked at this, it was somewhere between the 9 and 10% mark, very similar to Australia. I think I was sitting about 9.6%, if I'm right. I think New Zealand, I've got 9.8% sticking in my head, but I haven't done that analysis for a while. But that was across a long-run return. So, and that holds across sort of 20, 50 years periods. So, yeah, but very similar to what you'd expect in most major markets.
And what sectors are represented on the market?
Yeah, so like I say, there are a few, and there's some clear gaps as well. We certainly don't have the same incidence of mining or banking stocks that you enjoy in Australia. So tech
that we're totally reliant on in Australia.
So the tech sector is actually fairly well represented. There's some great tech companies that they form some attractive options for growth-focused investors looking at that sort of long-term growth. And
I mean, it's interesting, isn't it, that how many tech startups there are in Wellington alone in New Zealand?
Well, that's right. And look,
listed and unlisted companies. Yeah, Xero being one of the main.
Correct. So Xero is one of them. That was NZX listed. That is now, of course, listed solely on the ASX. But it still maintains its head office in Wellington. I suspect its operational base is probably more in Silicon Valley these days, but that's a different story. But yeah, that's an example of a tech company that grew. And yes, Wellington, it's not just Wellington, but certainly, right now there's other startups or growing businesses that are not listed. And I'll cite Henry as an example of that. So that's the next Xero. That's the accountant for sole traders, and they're actually accountants. And they will work through providing tax, doing your tax and doing your invoicing and so on as well. So it's actually a really interesting business model that they've got, and that they're certainly
what is it?
Strongly.
Sorry, just tell us a bit more about that. What is it? Henry is the name of the company, is it? And it's a private HNRY.
So yep, Henry, and yeah, they're actually
not listed yet.
Not listed, and the word "yet" is a really important one. One day, I'm sure they will have that need for capital, and we would hope they would look at a public market. But we'll talk about that as well if you like. But yeah, so certainly. But again, we seem to have this predilection in New Zealand for doing admin very well. We can think of Diligent Board Books, which of course was a Christchurch-based company, I think it was, before they decamped to the US. You have the likes of Xero, the likes of Henry, the likes of FNZ Group, who run a lot of the back end behind many of the world's fund managers. So we seem to have a predilection in a country of using technology to support admin, which is great.
Yeah, well,
and
it's also unlisted companies like NZX and Sharesight doing portfolio tracking, Sharesies doing brokerage platform. Yeah, there's plenty like that. It's pretty amazing.
There is, and there are opportunities. And I think as a culture in New Zealand, we're a small country. We have to export what we do, and we export capability as well. We have to do that to make our economy work. And I think it's a really interesting sort of cultural mechanism to have as you're growing up, knowing that you just have this outward-looking view of the world straight away. As a child growing up, I knew where the rest of the world was and New Zealand's place in it. It's quite a different feeling, I think, to many people that I've come across over my lifetime who've come from different countries.
Track your investments like a pro. Sharesight is Investopedia's #1 portfolio tracker for DIY investors, simplifying your finances. Get 4 months free on an annual premium plan at sharesight.com/shares for beginners. Let's face it, one of the few non-Italian supercars is a New Zealand car, isn't it?
Was that the Tuatara? Is that the one?
No, the McLaren.
Oh, that too. Yes, you're right. Oh no, we'll Google Tuatara in terms of cars. That's another one. But yes,
another one,
right.
Yeah, and the world's fastest Indian.
World's fastest Indian, yeah.
What about agriculture? Does agriculture play much of it? Because, New Zealand is famed for its clean agricultural products.
So sectors on the NZX, that's what we were talking about, wasn't it? So yes, tech, we'll come back to that. So tech sector is very well represented. So is healthcare through the likes of Fisher and Paykel. Admittedly, that is a very big beast. And I think it's competing with a slightly different business model with ResMed, an Australian-based company. It's one of its main competition. It's probably one of its main competitors. You've got power generation as a sector that's represented in New Zealand. That's probably not represented so well in Australia, actually. But that's that long-term utility type return. But actually, of course, thanks to decarbonisation, electricity generation is actually a growth sector at the moment. So there's a huge need for capital in New Zealand and probably in Australia as well for that electricity generation industry. So they need to decarbonise and manage that energy transition down the track. Property is a big deal here on our sectors. There's a number of listed property companies, retirement village operators, and they're kind of linked to the property sector as well, but of course they have that underlying tailwind of an ageing population demographic also. So look, there are a number of really interesting sectors you can get exposure to here, and some of them probably aren't that readily available in Australia. So in terms of the primary sector, the largest primary sector company in New Zealand is, of course, Fonterra, which is a cooperative. And that's a common model in a lot of those primary sector companies. How they grew up was as a farmer-based cooperative or grower-based cooperative. And that model is still, that's affected how many are actually listed for retail investors or institutional investors on the public exchange. So there's not actually too many listed. You have a Synlait, which has had a couple of issues in the last year, shall we say, or the last couple of years. You have A2 Milk, and of course that's listed on the ASX also, and that's a very successful marketer of A2 Milk. And there's also agricultural services companies like PGG Wrightson, who are a Christchurch-based agricultural consultancy, essentially, with a few other bits and pieces as well, including a chain of farm retail stores. So that's an interesting sector to be exposed to in a New Zealand context. And again, very long-term returns. That's not something you would necessarily trade in and out of, as probably A2 Milk investors discovered to their peril a few years ago. But also there's a lot of companies that are listed on secondary exchanges. So not the New Zealand Stock Exchange, but something like the unlisted stock exchange. And that reflects that cooperative nature of how they grew up. So companies like Zespri or LIC, Livestock Improvement Corporation, but those are companies where you need to be a grower or a farmer to actually own the shares in that. Silver Fern Farms is another really good example of that. And some of those are open to public investors. But actually there's a risk in that also, because you want to make sure that there's no trade-offs between the supplier shareholders and the non-supplier shareholders. And that can be an element of risk in investing in those types of companies for that reason. Now, I'm not saying that they haven't got the controls around that or that it's a dangerous regulatory regime, because it isn't. But it's just something for investors to be aware of when they're going into those types of companies.
So I believe Air New Zealand had some engine issues recently. How's that impacted the operation?
Well, That's a really interesting question, Phil. Air New Zealand would love more planes right now. They genuinely would. They can thank the tug operator at Brisbane Airport last week who knocked a plane of theirs out of action by punching a hole in the cockpit fuselage. They've now sorted that. That one's on its way to Singapore now for some heavy-based repairs after getting some initial repairs done in Auckland for that particular issue. But yeah, look, they have, like Qantas, they've been impacted by engine issues. They have a replacement cycle going on of those engines that's knocking out. And it's quite a high proportion of their long-haul fleet that's out of action right now. And that means they're having to heavily prioritise the routes that they operate. It's not great news for Air New Zealand, and I guess the company will be working very hard to ensure that its long-term market share in and out of routes in New Zealand is not compromised by that. But certainly it's had an impact in the short term. They're really focusing on their Auckland hub, and that's trying to make sure that's at the expense to some extent of market share in Christchurch and Wellington in particular, which major Australian gateways, and in Christchurch's case also a gateway to Asia. So that is having an impact on Air New Zealand's sort of long-term outcomes. It's not irreparable. I've got no doubt that once the engine issues are behind them, then they will be operating in a relatively stable manner as best they can within the confines of that industry.
So the funds management industry, where is it based in New Zealand? Is it both Wellington and Auckland, or other places as well?
So Auckland is really the main commercial centre. Wellington is very much the main political centre. And what's interesting from a New Zealand Inc. perspective, from a resilience perspective, is that you're seeing now a lot of... So Christchurch is actually the second biggest city, but it hasn't really featured in the commercial world to the same extent as, say, in Auckland or Wellington. But over the last decade, particularly since the Christchurch earthquakes that happened in 2011, my gosh, is that the right date? Yeah, I should remember that. I wasn't there. I was there not long afterwards. So certainly since then, you've seen a real heavy investment in Christchurch, particularly from domestic investors. And what you've seen there is a lot of investment banks opening up branch offices down there, some startup investment banks starting in Christchurch. You've seen the law firm, most of the major law firms now have offices there as well. So that's good from a resilience perspective for New Zealand. You've now got this sort of balance between Auckland and Christchurch in a way that really wasn't there before. So that's fast emerging as New Zealand's second commercial centre. So in terms of funds management, we haven't got the same plethora of fund managers that you might have in Australia, and that's simply a reflection of our smaller scale. But there are some great options, but a lot of those funds are based out of, the head offices are based in Auckland.
Just something that just came to mind, and I could be wrong about this, but are there fewer regulations for companies listing in New Zealand as compared to other countries? Is there a lighter regulatory burden?
No. There's definitely not a lighter regulatory burden. In fact, it's probably one of the higher quality. It's probably one of the higher quality regimes, and there's aspects. There's two things here. One is the base level of protection offered to investors through the Companies Act, and the other then is the listing rules, which are the additional protections that are offered to investors purchasing securities on the NZX. And the NZX and the ASX have slightly different rules. Basically, they're both fairly high-quality regimes. There are some elements where there's greater disclosure required in Australia, such as your remuneration reporting. And that uses very much, I would argue, a stick approach to get the reporting right. In New Zealand, the exchange uses the carrot approach to get the reporting right around there. And that's had a significant improvement over the last couple of years as they've improved the recommended disclosures around CEO remuneration in particular. But there's other areas where New Zealand's directors are subject to different tests that mean that there's different quality aspects where there's a higher standard in New Zealand than Australia. Certainly both markets are probably they offer relatively good investor protection, certainly compared to somewhere like the US or Canada, where those regulations simply don't exist to the same extent as they do here.
I know you're not an economist, Oliver, but what's your view of the Kiwi economy?
The Kiwi, it's had a rough couple of years. Australia is probably tracking about 6 months behind us ever since COVID happened and the post-COVID peak and then the trough that followed. Australia's been running a good 6 months behind New Zealand in terms of both the inflation aspects and the economic growth aspect as well. So but the New Zealand economy during 2024 was extremely poor. I mean, and that's reflected in the results that we saw from many domestically focused companies like the Warehouse Group, like Air New Zealand, who have a very strong domestic jet business here, of course. And there's probably a few others as well that elude my memory right now. Like Ryman Healthcare would be an example. So certainly those companies that were focused solely on a domestic economy really hurt during 2024. This, to some extent, that's rebounding in 2025, but it's certainly, there's no silver bullet to the recovery. It's not a quick bounce back. It certainly was not a soft landing that New Zealand went through. And that means that the bounce back is going to take time as well. But ultimately, those conditions for success are there. And look, the things that will be risks to those emerging green shoots of economic recovery will be things like the Trump tariffs in the US, the impact that has on global trade, already increased competitiveness within New Zealand as companies look to divert their production into the New Zealand market as well. So I think the watchword for investors this year is very much around watch the volatility of the recovery and the strategic and economic and geopolitical themes that can actually impact that.
When and how did you start investing? What initially piqued your interest?
I remember buying my first shares when I was 14. So that was at high school. I don't remember what shares were. I'll be really honest. I sort of kicked myself, and because I've shredded everything, I've no idea what they actually were. But I also remember that the brokerage was more than the shares were worth, which I thought was pretty fascinating at the time. And it was a salient lesson in how I've chosen to invest going forward as well. But I think that reflected a lot about the time as well. For a lot of people, investing was the sort of ethereal, up in the clouds type thing they never really felt they could access or see or relate to. And that was the world that I grew up in to some extent. My parents didn't come from money. I grew up in rural Canterbury in the South Island. And, from basically a working class type of family arrangement. And I think for a lot of people, investing was the sort of other world that they could never relate to or never see. I think we're lucky now, and that has clearly changed. I know the same thing has happened in Australia, where investing options become much more accessible for a whole wide range of people that could never have done that or contemplated that before. So that's the freeing power of information through the rise of technology and the internet, of course, but also the rise of low-cost broking platforms that have actually really helped people just get a little bit of skin in the game, and that helps people learn and understand. So I think what got me initially into it in a way was because, I did, like I say, I'd never had any exposure prior. My parents weren't into it. I didn't know anything about it. I did go to a school where that was fairly high in the school. I was lucky. And you saw that exposed me to a different set of demographics, a different set of people, and just piqued my interest around things.
Yeah, I've noticed that about Kiwis, that you come over to Australia and your education seems to be a lot higher in a lot of cases than here in Australia. And it's like you say, you've got this view of the world, because I think you seem to be implying that from a young age, you've got to be outward looking because there mightn't be opportunities locally.
Have to be. And that's a blessing and a curse, of course, Phil. We see right now we're suffering thanks to the economic recession in 2024, has an immediate impact on young Kiwis emigrating from New Zealand to Australia, of course. And there's quite a lot of Kiwis living in the likes of Sydney or the Gold Coast or Perth. So our diaspora is actually quite large outside of NZ. Many come back, and that's great for us because they bring all that knowledge with them they've learned and developed their capability further overseas. I'm probably an example of that, but many don't. And that's a sad loss for our country long term. So we do have to get that balance right over time and make sure that the opportunities are here for our young people and where they can grow and develop and thrive.
So you personally, do you invest mainly locally or internationally or a combination?
So I run it's almost a mechanistic approach. But I think in terms of my own approach, I've got a very clear investment strategy. So I know what my long-term goals are.
Oh, I can't wait to hear this.
No, it's really simple. It's not rocket science, though. I don't think it is. So look, investment strategy, very much long-term, and that's just a simple set of objectives that reflects what we want to do long-term, as in me and my wife. So, and I guess I am probably a fairly long-term investor, so I'm very much focused on growth. So quite an aggressively geared portfolio towards equity, and I'm prepared to be very patient in terms of the capital that I will supply. I mostly invest in public markets. I've got a few investments in unlisted investments as well, and a few in funds, but it's mostly in public equity markets because I do think that trade-off for risk versus the investor protection you get from the transparency associated with a public company, I do think that makes a difference. So I'm not just chasing return. I try to have a set level of risk and then I maximize the returns away from that set level of risk. maximise my returns given that set level of risk. And that's part of the investment objectives that we have. The way I'll work that is, so I'm essentially running my own little statement of investment and investment objectives. So that sets out each of the investments. I justify each of the investments against that. We have a clearly defined portfolio allocation, which is allocated to both how much we invest actively, how much we invest passively, and that could be either direct investments or ETFs. But also then, how much we target towards different geographies, and whether that's also then, direct investment or through funds or ETFs. So it sounds complicated. It's not. It's just, I guess,
just
I know
go
my
into
limits.
it. Go into it. Yeah, go into it a little bit more. What if you got a little checklist? You sort of said that there's a kind of Tell us about that.
I have an algorithm and a spreadsheet. So basically, I track how my portfolio is doing against different benchmarks that we set or different allocation models that we set in terms of geography, sector, and the style of investment, whether that's direct or indirect. And I'm looking to optimize across that against a defined level of risk and trying to maximize my returns away from that. Diversification to me is really important. I'll make the way we set those allocations is really through looking at what are the key economic or thematic or economic themes or geopolitical themes. So the thematic type approach and saying where don't we want to be. So does, for example, the introduction of tariffs into the US, does that increase vulnerability or increased risk of good investor returns from the US market? We would argue it does. So when I say we, I mean me and my wife, we do talk about this. So I will then look to diversify or reduce the portfolio allocation that we're allocating to the US. I don't just look at where the stocks are listed to get that allocation. We look through the stocks to say, or the ETFs to say, what's the underlying exposure? So if you're looking at a particular ETF, it might be listed in Australia or it might be listed in the US, but that doesn't mean it's all US exposure. So we look quite carefully at what those sector balances are and the country balances are. And there's some, so we use portfolio management tools like ShareSite, but also have my own spreadsheets to augment that in terms of understanding some of those aspects.
Yeah, I've heard ShareSite's main competitor is the spreadsheet.
It is, and
I mean, are you one of those spreadsheet tragics?
Look, I have to admit, I love a good spreadsheet. My wife always hassles me about that. So, we have fascinating conversations, and she tends to groan and walk away when I start talking about spreadsheets. But
please feel free to nerd out here on spreadsheets. What is it? What is it that you're setting up that is helping your investing? Yeah,
so look, I do track daily prices of stocks, and there's some great functionality in Excel that lets you do that these days. That'll give me, I can calculate it within a beta or how much the stock varies compared to an index over time. So I'm looking at things like that. I'm just looking at, and then I tend to use ShareSite or more for actually understanding that wider portfolio allocation, the wider portfolio return over time. I do the allocation models and algorithm that's driven through Excel as well. And that's just telling me am I overweight or underweight in that. I do tend to use or create, if I'm looking at a direct investment, I will look to understand, as I said, the first thing for me is the thematic. So those external impacts that can hurt a company or
they call that top-down investing, don't they?
Top-down investing. Then I start looking at a company strategy and trying to look at what I think is the best company, but that's an active choice. So yes, it's essentially a form of stock picking. And then I'm valuing that company from a financial perspective, and I'll do that through having an effective discounted cash flow model. I'll be comparing the assumptions in that cash flow model to what occurs down the track as well. So you're using a variety of sources to inform that. Some of it's conversation with the company. Even before NZSA, I was never shy about ringing a company and asking them what was going on. I think that's important.
I think that's important for investors to know that you actually can call a company and ask them questions. Yep. Yeah, anywhere in the world.
Yep, and New Zealand, and I do it as part of my role at NZSA. We're very keen that companies do engage with investors, and I think when companies have their results and they have their analyst briefings afterwards, and many companies in New Zealand now, they will make that available for all retail investors to attend as well. And I think that is important. Using corporate sources. Attending shareholder meeting is actually important because you get stuff coming from the questions. You get more insight from the questions that are asked, and that helps you form an opinion as well. That's why NZSA and ASA perform such an important role, because we are reporting on those meetings, on the questions that were asked, on the themes that were raised. So, yeah, look, I think there's a variety of both commentary, media, analyst reports, your own questioning of the company and the company material itself. Looking at their presentations and looking at the annual reports. And from that, you can make some assumptions around, okay, what happens? And then, so I'll model that out and see what it looks like, and then I'll track that model over time to see how wrong I was, but obviously amend it. And that's a constant interplay of how's the company performing against that particular set of assumptions that I've made. But so I'm constantly testing and retesting assumptions.
You sound pretty passionate about this, and you spend a lot of time, and you love it, don't you?
I think, well, yes. But
because I think this, sorry, I just wanted to say, I think this is a lesson for people listening, is that if you want to invest in the share market directly and look at your investments, it's a lot. First of all, it's complex, it's long term. You've got to be passionate about it. It's not something that you just sort of sit there and do for a week and then forget about it, do you?
I would
there's ETFs for that if you wanted to do that. But anyway,
that's right. And I think I would absolutely agree with that. So it comes down to sort of this beautiful intersection of your own constructive energy and your own capability around that. And it's not easy, the whole thing of, going onto shares and buying shares just because everyone else is doing it. Well, that's not me. If anything, I'll look at that and say, that's interesting. And then I'll look for, is there a contrarian position around that? But yeah, so I don't tend to follow the herd in that respect. It's looking at objective data, independent analysis, and actually trying to work out, okay, what's appropriate here as a decision I can make. And I tend to keep that fairly close because obviously I'm not an advisor, so I don't say too much about what the analysis is showing, because it's just, and particularly in someone in my role, that's not right to do that.
No, of course not.
But the other thing I do look at is how a company is governed. So you're looking at the quality of its governance, and you're looking probably at its track record as well, and how that has fed into investor sentiment. Now, I know that track record is no guarantee of a future, but it does tell you something about capability, both of the board and of those senior managers. So that is important for me, and that helps with making decisions. And one of the things that I really believe in from a New Zealand perspective is we're a small market. Yep, and like any market, like most Western markets right now, we need capital, right? But because we're small, actually we can have a quite high quality set of governance practices and rules and conduct in place and still attract enough capital for us to, on a global business scale, to satisfy what most New Zealand companies or our economy is looking for in terms of capital investment. So I'd rather have a really high quality market that inspires confidence for investment. And that very much translates to how I look at things as well when I personally choose to invest.
Tell us about some time when you were wrong. And I mean, when you're looking at companies and you've got a thesis and you've decided to invest and you've put some capital into a particular company or sector, what is it that identifies you being incorrect?
I think the key thing that springs to mind here is time frame, because sometimes I might be wrong, and any active investor will know this. Long term, and all the research says you can't beat a passive market. So the things that I don't know, I'm really happy to invest in a passive ETF, right? So I don't invest directly in the US market. I know most people do, and people are probably listening to this going, what is he not doing that for?
But I just buy Apple, load up on Apple.
I simply cannot get my head around the sheer number of companies that are listed in the US, investment options there. I'd rather have a professional do the job for me. So at that point, I choose not to invest in the US. But I do invest in Germany directly, for example, because I work there, I understand that market a little. I feel I can get my head around what happens in some sectors of that listed market.
What is it about Germany that makes you feel comfortable?
So right now, given the geopolitics aspect, I have, made some allocation decisions around Europe versus US. And so that means I'm sort of shifting capital to go and fulfill that. And, I probably started that relatively early, which has worked out rather well for me right now. And some of that's through ETF type structures, but a lot of it is through direct investment in certain companies or sectors that I think frankly will offer future value that isn't reflected right now. But ultimately, you're taking an assessment. So whether I'm right or not, that's the conversation we're having. And some of it sometimes is simply down to timing or time frame. So if you're making an investment decision, I mean, I don't believe necessarily in fully timing the market because I don't think you can. You can't consistently get it right every single time. So I'll always look to the long term, and I'll look for companies that I think offer fundamental value that is not yet reflected in the market value of the share price. Sometimes that market value may take a longer time frame to realise than I have initially thought. So the strategies I look at personally to go and cope with that, it's pretty rare that I'll sell out completely. But what I might do is buy more, so I'm dollar cost averaging. And that can be a fraught strategy, of course, because you're still having a fundamental belief that you still believe in what this company is doing, what the company's strategy is. I've got one investment at the moment that I bought at completely the wrong time. I still think it has value, but I'm well underwater on it, but I'm hanging on to it. And I have averaged down to some extent on that, but I'm not willing to skew my portfolio in such a way to fully reflect the money I need to put in. So I'm still running within certain guardrails within my portfolio in terms of how I look at individual investments. And I do want to maintain that. So, and that's a protection mechanism, so you don't get overexposed to one particular bad investment. At the end of the day, if it fails completely, then I still have enough returns from elsewhere to offset that, and it's not going to hurt the wider portfolio. On the other hand, if that time frame to recover is longer and it does recover, then things are looking pretty good. But yeah, so mechanisms like dollar cost averaging are helpful for me, retesting and testing those assumptions that I've made, and am I wrong? And I'm not afraid to sell out at a loss if I've got it wrong. And I'll try to do that
that's
earlier
really
rather than
important,
later.
isn't it? Investing, just realising when you're wrong.
I think a lot of people are great buyers, but they're bad sellers. And it's something that we've talked about at NZSA as well from an investor psychology perspective. So I'm not particular, if I've got it wrong, I'm not shy about saying, hey, I've got it, and just recognising that and taking the haircut, because inevitably I can reinvest that money and I'll get it right next time. So, yeah.
I saw on your bio the Scout Youth Foundation Investment Committee. What is it and what's your role?
So Scouts New Zealand, and of course the Scouting Australia as well. So that's a global movement. So Scouts NZ has an endowment fund that was set up by a coalition of the willing a few years ago. So I'm on the investment committee for that. What we look to do is generate a return to put back into scouting for disadvantaged families or for specific projects where the money might otherwise not be available. It's only small, but it's growing rapidly. And yeah, it certainly made a difference to many people who wouldn't otherwise have been able to participate in Scouts NZ and Scouts New Zealand activities. Yeah, and look, I do believe that scouting does make a difference to people's lives. It instills it works and focuses on certain leadership qualities. It focuses on giving people experiences they wouldn't otherwise be able to achieve. So I do believe in that as a core premise, and there's value in that.
Yeah, and getting kids off their devices.
Yep, that too.
Why did you join the New Zealand Shareholders Association? What is it? I think you're just the personality type that likes that, especially with your interest in governance.
Well, I think so. But interestingly, so I joined as CEO, as you said in your intro, back in October 2020. It feels like quite a while ago now. And for me, really, it was an intersection of a couple of things. One, yes, it played to my sort of underlying interest, if you will. But also, I was a bit of an inflection point in my own career, in my previous career, where I felt I'd been typecast since returning to New Zealand. It's a very common problem for returning expats. And I wanted to use that sort of full range of skills that I grew up with, that holistic set of active skills that I have, rather than being pigeonholed into one particular area. So I think NZSA, that's why it attracted me. It meant that I could actually make an impact in a way that helps New Zealand investors and helps international investors have confidence in New Zealand's market. And I do think that matters. We have a very high quality regulatory regime here. Investors can have confidence in New Zealand's market. Part of my role is to look at that and make sure that we understand the quality of the companies that investors are investing in. So for me, that mattered. Might sound a bit pointy-headed, but actually it really does matter to me. And because I have a relatively broad background, actually I can talk at many different levels and I can understand many different facets of an organisation, how it operates, how it works, and how the governance might relate to that organisation. So I think that was what attracted me into that role, and certainly I think it's been a relatively... I think NZSA has been very good for me, but also I think I've been good for NZSA, and I hope to continue that for some time yet. In terms of as an investor, though, interestingly, I'd never heard of NZSA. before I saw the advertisement for its CEO. So that's quite telling for me. If I'm someone who's into this, and yes, admittedly, I hadn't been back in New Zealand that long, and I've been overseas for a lot of the period when NZSA was formed and founded and growing up. But it was interesting to me that there was this organisation here that was catering to my needs as an individual investor, but wasn't advocating on my behalf. But I'd never heard of it. So I think for me that's a real opportunity, and we haven't cracked that yet at NZSA. I would like to see our organisation move to be a significant voice for all individual investors, no matter their age, stage, demographic, experience. And we have a lot more work to do to achieve that.
Well, we've got quite a few New Zealand listeners to this podcast, so pitch to them now. Tell them about it.
Now.
How much it costs and what are the benefits and everything, yeah.
So NZSA as an individual member costs $145 a year. And of course, if you have an investment portfolio, that's likely to be tax deductible. Please consult your tax advisor for that. Really what we aim to be is that we protect, we empower, and we enable and we reward your investment. And we are that voice for retail investors in New Zealand, and we'll advocate on your behalf. That means that things are happening in the background. We have the credibility and the influence to have the right conversations with people to inflect change for the benefit of individual investors where that change is required. So really we're kind of a force for good in capital markets in New Zealand. And I think most of the industry stakeholders here, that they respect NZSA's position in the market and its voice in support of individual investors. So that's what we're here for. Sometimes you might get a direct benefit. A lot of the times the benefit is behind the scenes. But we are active in those conversations in terms of how corporate boards are shaped and the skills they need to have and how they interact with investors as well.
And is there a website the listeners can go to?
www.nzshareholders.co.nz, and you'll see a big Join Us button there. Just hit that and join us.
Oliver Mander, thanks very much for joining me today. It's been great to hear about what goes on in the land of the long white cloud. And do you have to do a haka when you list on the NZX?
No, there is an opening bell, just like there is in the ASX. And so companies...
I think that should be instituted. I think you should be lobbying for it as part of the
companies
NZSA.
do ring that bell, and I'm sure our local exchange would like to see a lot more companies ringing that bell in the near future. So, yeah.
Thank you very much.
Phil. It's been great to talk to you today, and at any time.
Thanks for listening to Stocks for Beginners. If you enjoy listening, please take a moment to rate or review in your podcast player, or tell a friend who might want to learn more about investing for their future.